Most chart patterns stop working over time because markets evolve, algorithms get smarter, and traders adapt. But there's one pattern that still performs in 2025, even in fast, unpredictable market conditions. And no, it's not some magical pattern. It's not some secret strategy. It's a pattern built directly on human psychology, which hasn't changed in decades. Today, I'm breaking down the only chart pattern that still makes sense in modern trading, why it continues to work, and how you can use it without falling for hype or unrealistic expectations. Let's break it down. Clean, simple, and beginner-friendly. Welcome back to the trading series. If you're new here, check the I button on screen to watch the last episode, Why Traders Lose Money Before They Even Enter a Trade. It'll help you understand the psychology behind today's pattern. The pattern, the bullish flag pattern. Let's start with the basics. The flag pattern is a continuation pattern. It appears after a sharp, clean upward move, called the pole. Then the price enters a small consolidation, usually forming a downward or sideways channel, the flag. The moment price breaks above the upper line of that flag, momentum typically continues in the same direction. But here's the key part that newer traders miss. This pattern does not work because indicators say so. It works because crowd behavior repeats itself.
Part 2. Why the flag pattern still works in 2025. Let's talk about the real reason. Markets change, institutions adapt, algorithms evolve. But human emotion hasn't changed. Not in 2020, not in 2024, and definitely not in 2025. Here's the simple psychology behind the flag pattern. 1. Momentum excites traders. When a price shoots up quickly, everyone sees it. Beginners hesitate, experienced traders take small profits. Institutions wait for liquidity. 2. Consolidation creates confidence. When the price cools down and forms a tight channel, people feel safe. They think, okay, the move didn't collapse, something is building. 3. The breakout triggers fear of missing out. Once the price breaks out of the flag, late buyers jump in, small sellers panic, and momentum continues. This whole cycle is behavioral, not technical. That's why the flag pattern keeps working, because humans react the same way every year.
Part 3. Real charts example breakdown. Let's break down how it actually looks on charts. Imagine a stock skyrockets from $100 to $118 in 30 minutes. That's your flagpole. Strong, clean momentum. Then, the price cools off, pulls back to $114, moves sideways between $113 and $115. That's the flag. Now, watch closely. The moment price breaks above $115.10 with a strong candle, volume spikes and momentum continues upward. This is not a guarantee. It's simply a high probability continuation of existing strength.
When the flag pattern fails, no pattern works 100% of the time, not even close. The flag pattern fails when 1. There is no real momentum. If the flagpole was weak, the breakout is weak. 2. Volume does not support the breakout. Low volume equals low confidence. 3. The market is sideways. Continuation patterns don't work when the market has no direction. 4. Traders enter too early. If you enter inside the flag randomly, you're basically gambling. A pattern is only as good as the context around it.
How to use it safely. Here's a clean, beginner-friendly approach. Step 1. Identify the flagpole. Strong, fast upward movement. Step 2. Draw the flag. 2 lines capturing the small pullback. Step 3. Wait for a candle close above the flag. Not wicks, not predictions. Actual close. Step 4. Check volume. A breakout without volume is a false breakout. Step 5. Set stop loss below the flag. Keep risk small. Avoid emotional decisions. This keeps you structured, disciplined, and safe.
Thanks for watching this episode of the Trading Series. If you want the breakdown of the second most reliable pattern of 2025, the triangle breakout, click the video on your screen right now. And if you're new to chart reading, I added a full beginner playlist at the end screen as well. See you in tomorrow's episode.